Forex trading offers lucrative opportunities for profit, but it also carries inherent risks that can lead to substantial losses. Successful traders understand the importance of risk management in safeguarding their investments and preserving capital. In this article, we'll explore effective risk management strategies that Forex traders can implement to protect their investments and navigate the market with confidence. 1. Understanding risk in Forex trading. Risk in Forex trading refers to the potential for financial loss resulting from adverse market movements. Several factors contribute to trading risk, including volatility, leverage, market liquidity, and geopolitical events. While it's impossible to eliminate risk entirely, traders can mitigate it through proactive risk management techniques. 2. Setting stop-loss orders. One of the most fundamental risk management tools in Forex trading is the stop-loss order. A stop-loss order is a predefined price level at which a trader's position is automatically liquidated to limit losses. By setting stop-loss orders at strategic levels based on technical analysis or risk tolerance, traders can minimize the impact of adverse price movements and protect their capital from excessive losses. 3. Calculating position sizes. Proper position sizing is essential for effective risk management in Forex trading. Traders should calculate position sizes based on their risk tolerance, account size, and the distance to their stop-loss level. By risking only a small percentage of their capital on each trade, e.g. 1 to 2%, traders can ensure that a series of losing trades does not significantly deplete their account balance. Additionally, adjusting position sizes based on market volatility can help traders maintain consistent risk exposure across different market conditions. 4. Diversifying trading portfolios. Diversification is a key principle of risk management in Forex trading. Instead of concentrating all their capital in a single currency pair or trade, traders should diversify their trading portfolios across multiple assets and currency pairs. Diversification helps spread risk and reduces the impact of individual trade losses on overall portfolio performance. By incorporating assets with low correlation, such as currencies from different regions or asset classes, traders can further enhance portfolio diversification and minimize risk. 5. Avoiding overleveraging. Leverage amplifies both potential profits and losses in Forex trading, making it a double-edged sword for traders. While leverage can magnify returns in favorable market conditions, it also increases the risk of significant losses, especially during periods of market volatility. To mitigate the risk of overleveraging, traders should exercise caution when selecting leverage ratios and avoid excessive leverage that exceeds their risk tolerance. By using leverage judiciously and prudently, traders can protect their investments and avoid the pitfalls of overleveraging. 6. Remaining flexible and adaptable. Flexibility and adaptability are essential qualities for successful risk management in Forex trading. Market conditions are constantly evolving, and traders must be prepared to adjust their strategies and risk management techniques accordingly. By remaining vigilant and responsive to changes in market dynamics, traders can minimize losses, capitalize on opportunities, and adapt to shifting risk profiles effectively. Conclusion: risk management is a fundamental aspect of successful Forex trading, essential for protecting investments and preserving capital in a volatile market environment. By implementing risk management strategies such as setting stop-loss orders, calculating position sizes, diversifying trading portfolios, avoiding overleveraging, and remaining flexible and adaptable, traders can navigate the Forex market with confidence and resilience. Ultimately, effective risk management empowers traders to weather market fluctuations, minimize losses, and achieve long-term success in Forex trading.